Hey everyone, Q1Fy26 earnings season is in full swing. And despite all the noise and volatility in the market, a few companies have quietly delivered blockbuster results. We are talking about names that not only beat street estimates, but also gave confident guidance for the coming quarter, signaling strong business momentum. So in today's video, we are diving into some of these standout performers across diverse sectors like auto, capital goods, specialty manufacturing, IT, cables, and even value retail. We'll break down what is driving their performance, what the management is guiding for, and most importantly, whether there's still an investment opportunity there. Some of these names are familiar that we have been tracking for a while, and a few are surprise outperformer that might just deserve a spot on your watch list. So let's get started. First company in the list is from Indian power sector. It's Transrail Lighting. Company's revenue has jumped by 81% year on year. Net profits are up 105%. Please note that quarter on quarter you will find the revenue and net profit lower, but it is not a right comparison because business of Transrail is H2 heavy. That is second half of the year that include Q3 and Q4 are always higher than Q1 and Q2. The most interesting aspect is Transrail management has guided for 20 to 25% top line growth in FY26, but delivered 80% growth in Q1. I've recently covered Transrail business in detail a couple of months ago. If you want to understand the business, do check that video. Transrail is primarily involved in power transmission and distribution, railway electrification, and EPC projects. It is emerging as a key beneficiary of India's power transmission push. Today, Transrail commands a market cap of around 10,000 crore, and a good part is that even today it commands a P of around 27-28, which is quite attractive for the growth company is showing. Second company is from pharma and specialty chemical space. It's Ami Organics, now known as Acutaas Chemical. Company's revenue is up by 17%, but its EBITDA has jumped by 72% and PAT growth is exceptional at 215%. Ami has been on high growth trajectory and management is quite upbeat on future with guidance of 25% top line growth along with margin expansion. Again, I've discussed Ami Organics multiple times in the past. Ami basically manufactures key pharma intermediates and advanced intermediates used in API, which is a strong presence across regulated market of US and Europe. Company has also entered a joint venture in South Korea to tap the high value semiconductor chemicals. Its electrolyte additive capex of 177 crore is expected completion by Q4 of FY26. Today, company command a market cap around 10,500 crore with a PE of around 56. Valuations are on higher side, but Ami will command a premium due to its superior growth potential ahead. Third company in the list is Netweb Technology. Company's revenue is up by 102%, EBITDA has jumped by 127%, and PAT growth is 100% year on year. If you recall, we have discussed its business in detail. Netweb is one of India's fastest growing player in high performance computing as well as AI solution space. Company designs and manufactures supercomputing systems, private cloud setups, enterprise workstation, and even AI/ML infra, all critical for data economy. Interestingly, company's management has guided for revenue growth of 35 to 40% CAGR till FY27. So this quarter result has certainly exceeded the guidance. Currently, Netweb command a market cap of around 12,000 crore with a PE of 92. Basically, market is giving it a PEG ratio of around 2, which is slightly on the higher side. But considering the growth, company will command a premium. Now here, one very important aspect is when you invest in a company, you can't just buy and forget. Even long-term investing requires close monitoring. For instance, today Netweb is performing exceptionally well and market is rewarding the shareholders. But what if the growth slows down? In that case, PE of 90-100 won't be sustainable. That's where I keep a close eye on more than 200 quarter results in my weekly video series where I deep dive into businesses and try to understand the growth potential, key risk, and so on. This really helps in identifying right businesses for investment. In this series, I also share my own investment strategies. Please note that the idea behind this series is not to give you buy-sell call. The idea is that for a person with a job or business, it's really difficult to keep a close eye on the market. That's where I try to add value with close market monitoring. Since we are in festive season of Rakhi, there's an additional discount, but only for limited slots. For more details and promo code, you can check out the pinned comment. Fourth company is from recycling sector. It's Pondy Oxide. Company's revenue is up by 36%, EBITDA has jumped by 83%, and PAT growth is 90% year on year. Pondy Oxide specializes in recycling lead, zinc, and other non-ferrous metal from industrial scrap and waste batteries. These metals are then used in sectors like batteries, chemicals, electrolytes, and even electric vehicles. With growing focus on sustainability and import substitution, Pondy Oxide business model is gaining strong tailwinds. Please note that we have already covered Gravita India from very low levels, which is the leader in this segment. Gravita results are also good with 15% revenue growth and 38% PAT growth. But Pondy Oxide Q1 results are exceptional. I track both the companies from metal recycling space. Both companies currently command similar valuation, but from market cap perspective, Pondy is around 3,000 crore company and Gravita is around 13,500 crore company. As far as growth is concerned, Pondy management has guided for 15% CAGR volume growth till FY30 with 20% CAGR revenue growth, whereas Gravita has a target of 25% CAGR volume growth with 35% CAGR profit growth. Valuation wise, both command similar PE of around 40. Next two companies in the list are from IT mid-cap space. First is Coforge. Company's revenue is up by 56%, EBITDA is up by 87%, and PAT growth is 88% year on year. Coforge specializes in digital services, particularly for BFSI, travel and transportation, and healthcare. Company has been investing early in cloud, low-code platforms, and AI-driven solutions, enabling them to capture a higher share of digital transformation budgets, even when traditional IT spends are being cut. Second company is Persistent System. Company's revenue is up by 22%, EBITDA is jumped by 34%, and PAT growth is 39% year on year. Persistent has always positioned itself as a digital engineering specialist. While legacy IT services are under pressure, clients are still spending on cloud, AI, data analytics, and product engineering, which is Persistent's core strength. Also, Persistent is increasingly winning large multi-year digital transformation deals. At the moment, Coforge command a market cap around 54,000 crore, whereas Persistent market cap is around 80,000 crore. Valuation wise, both command premium valuation at similar level, where Coforge is PE of around 55-56 and Persistent is PE of around 52-53. While short term might be tricky for IT companies, but both are looking promising for long term. Next, there are two companies in the list from affordable housing finance sector. First is Home First Finance. Company's AUM has grown at 28.6% and net profit is up 35.5%. Asset quality is stable with gross NPA at 1.8%. Slight 10 BPS increase, then DPD, that is days past due, which is forward key indicator of asset quality, has slightly increased by 50 basis point, and ROE has fallen by 210 basis point. But overall speaking, I think growth is excellent. Second company is India Shelter. Its AUM has grown 34% and net profit is up 43%. Asset quality here also has seen slight deterioration of 10 BPS in net NPA, and DPD of 30 plus days has jumped by 1.5%, which is on higher side. Here we need to track asset quality very closely. But broadly speaking, affordable housing is certainly a high growth space within NBFC segment due to growing urbanization and massive underpenetration. Companies like Home First and India Shelter have created a strong niche in the space and use of technology that has resulted in quick loan disbursement. Home First management has guided for more than 25% AUM growth in coming years, and India Shelter management has guided for 30 to 35% AUM growth till 2030. Of course, here the key is to track the asset quality. Home First has a market cap of around 13,400 crore and India Shelter is trading at a market cap of around 10,000 crore. Valuation wise, Home First command a price to book of 4.3, whereas India Shelter price to book is 3.7. Next company in the list from alcohol sector, it's Radico Khaitan. Company's revenue is up by 33%, EBITDA is jumped by 56%, and PAT growth is 82% year on year. Now, alcohol beverage is one sector I have been tracking for a long time and discussed it in detail on our YouTube channel. After long tracking, one thing I have clearly understood that India was a land of whiskey lovers and it will continue to be the same. Earlier, I thought that maybe wine sector could do well with rise of premium dining, but data clearly suggests that Indians prefer whiskey over anything else. No wonder Radico Khaitan is one of the fastest growing company in the sector because it has cracked the whiskey sector that includes its flagship brand Rampur Indian Single Malt Whiskey. Apart from this, its 8 PM whiskey is also one of the world's top selling whiskey brand. Within vodka, its Magic Moment vodka is again a top selling global brand. Then its Jaisalmer Indian Craft Gin is also very popular. Also, company has very strong distribution and deep rural penetration. Plus, its brands like Rampur Whiskey and Jaisalmer Gin are gaining a lot of popularity outside India. That is resulting in huge export revenue. Please note that unlike peers who rely heavily on contract bottling, Radico has its own plant which improves margins and control over quality. All these factors have resulted in massive growth for Radico Khaitan. And considering the love for alcohol, the demand for its product would only increase over time. Currently, it commands a market cap of around 37,000 crore. Only catch is, due to high growth and solid brand building, company always command a premium valuation. But then its premium is justified. A pure portfolio grade company. Next company with exceptional Q1 performance is Laurus Lab. Company revenue is up by 31%, EBITDA is jumped by 123%, and PAT growth is exceptional 1,192% year on year. Yes, that's not a typo. Now, if you recall, I've discussed Laurus Lab multiple times in the past. In fact, last year when its stock price was crashing, I did a detailed video on it and explained the reason for it. I clearly mentioned that company is in massive capex phase of 2,500 crore, and once the capex get over, its revenue and net profit would bounce back. And Laurus Lab is doing exceptional work in cancer treatment technology. In case you want to cross-check, do watch that previous videos where I clearly said there's no need to panic. The thing is, it's not easy to keep conviction when you don't have right knowledge about the business. And that's where individual stock picking is a little tricky. On top of that, social media today amplify everything. When there's negative news or business underperform, people start criticizing it. I remember people used to call Laurus Lab as bogus lab. And look at what has happened to this bogus lab now. Stock is up 100% in last 1 year. Something similar is happening with IT today as well as your ER&D sector companies. People are hating it. But I'm confident on long-term prospect of IT and tech companies. Of course, you need to be selective here. At the same time, the problem is when there's good news, everyone wants to jump into the bus, and that's what makes the valuation high. So it's important to keep a fine balance between momentum buying as well as value buying. And most important, you need to keep patience and conviction during challenging times. It's difficult, I know, but that's what separates the winners from the losers. Next company with top Q1 performance is InterArc Building. Company's revenue is up by 25%, PAT growth is 40% year on year. InterArc is a leading player in fast-growing pre-engineered building and steel construction space. With India's infrastructure and industrial capex cycle picking up, companies like InterArc are well positioned to benefit. Management has earlier guided for 20 to 25% growth, and current performance is much better than the guidance. Currently, it commands a market cap of around 3,100 crore. Valuation-wise, it's trading at a PE of 34. Although valuations are not cheap, but the kind of growth company is showing, it is justified. Next company is from value retail sector. It's V2 Retail. Company's revenue is up by 52%, EBITDA is up by 57%, and PAT growth is up by 51% year on year. V2 Retail primarily cater to the aspirational middle class and low income segment in tier 2 and 3 cities with focus on value for money fashion. Its strength lies in sourcing efficiency, affordable pricing, and a no-frill store model which keeps cost low while driving volume growth. And there's a clear trend where people in tier 2 and 3 cities are switching from small mom and pop shops to such retail chains where they are getting much better shopping experience at an excellent price point. I've already discussed this sector in detail. Do check that video. Next company in the list is Craftsman Automation. Company's revenue is up by 55%, EBITDA up by 34%, and PAT growth is 42% year on year. Craftsman specializes in precision manufacturing solutions that include automotive powertrain component, automotive aluminum products, as well as various industrial and engineering products like storage solution for warehouses, special purpose machine, and so on. Company's management has guided for 7,000 crore top line in FY26. That shows 20 to 25% growth from FY25 level in top line, and EBIT of 650 to 700 crore, which is 30 to 35% upside from FY25 level. Craftsman is a dual play on Indian auto sector as well as structural growth in manufacturing sector. Another company from auto sector that is leading from the front is TVS Motors. Company's revenue is up by 18%, EBITDA is up by 26%, and PAT growth is 34% year on year. TVS Motor has clearly established its leadership in two-wheeler auto sector of India, including EV sector with its iQube. Company has been delivering exceptional performance in last few years, and I expect this outperformance to continue. Next set of exceptional performance is from Indian electronics sector. There are 4 companies actually. First is Dixon, that has delivered 95% growth in revenue and 68% growth in net profit. Second is Keynes, that has generated 34% top line growth, 47% bottom line growth. Third is Ember with 44% revenue and 44% net profit growth. Fourth is Avalon with 62% revenue growth and 715% net profit growth on small base. Clearly, Indian electronics sector is showing massive growth. We identified the sector long back and discussed some of these companies from very low levels. Even today, the opportunity size for electronics sector is immense due to two factors. First is the growing demand. We have a market of 140 crore people where demand for electronics is only increasing with time. And second factor is growing focus on reducing dependence on China and focus on Atmanirbhar Bharat. The only catch is all these companies command super high valuation. And these companies have dependence from Indian government in terms of PLI benefit. I understand that the kind of growth these companies are showing, they deserve such premium. But my only concern is it would take one bad quarter for valuations to crash. So for these companies to continue to command such premium valuation, they need to continue this outperformance. At the moment, all four are looking promising, but investment in these companies would require very close tracking. Last set of outperformers are from cables and wire sector. First is Polycab. Company's revenue is up by 26%, EBITDA is up by 47%, and PAT growth is 57% year on year. KI revenue is up by 25%, EBITDA is up by 18%, and PAT growth is 30% year on year. Both companies continue to benefit from India's massive investment in power transmission, rural electrification, and renewable projects that is significantly boosting demand for cables and wires. Polycab today command a market cap of around 1 lakh crore, whereas KEI market cap is around 36,000 crore. Valuation wise, both are almost at par. A slight premium to growth at PEG ratio of around 2. But again, the tailwind is quite strong for this industry. So that wraps up some of the strongest Q1Fy26 results we have seen so far. While the broader market is still navigating uncertainty, companies with strong execution, niche positioning, and long-term tailwinds are quietly delivering. But remember, great results don't always mean a great buying opportunity. Valuation, growth visibility, and sector outlook matters just as much. Some of these stocks have already run up, while others may still offer a margin of safety. So always do your own homework before investing. Let me know in the comments which of these names are you tracking. Or if you want a deep dive in any of the company, I'll be happy to cover that. And as always, don't forget to like, share and subscribe for more honest research-backed investing context. I'll see you in the next video. Till then, take care.